Hello, Smart Management Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Greetings for another wonderful Friday spent with you, Kirk.
It's a Good Friday, Doug.
It is actually, it is, but it's an amazing Friday. I don't want to
It's an
undersell
amazing Friday, but it's also a Good Friday.
it. It's a good Friday. Yes. So happy
Yes.
Easter. Happy Easter to everybody.
Happy Easter. Happy Good Friday. Happy all the stuff. You know, is Passover? I forget what the date is. Is Passover the same time or?
They correlate. Yeah.
Yeah, I forget the date of
I don't think the
Passover. Well,
dates are
happy Passover.
exactly. Yeah.
Yeah. So, all right. Well, happy holidays, everyone. I hate to say that, but it is a bunch of holidays. So, yeah. So let's dive right in. So the market's closed today. Thankfully, I think we can all use a day off from the market being open and going up and down every which way. We had a bunch of stuff we want to talk about today. The first is we don't want to leave this out. We didn't have enough time to prepare for last week, but for those of you who are not aware. Chuck Norris passed about a week and a half ago. I do a moment of silence, but this is a podcast. So, in honor of Chuck Norris, we're going to do some Chuck Norris jokes. If you're not familiar with Chuck Norris, he is notorious for these. Doug, did you pull these up? We'll just go one after the next.
I did, and if I can find some extras, but we'll nail through these. Yeah, I found these. Now, there's lots of good Chuck Norris jokes, but we tried to tie these a little bit into the topic of finance and markets. So.
Yeah, we'll just we'll tie those in. So yeah, so so Doug changed mine a little bit. All right. So I gotta figure out where we start. Okay. What did you do? Oh, sorry. Yeah.
I did nothing.
Were
You
these
had
all
it first.
yours?
Yeah.
Oh, the
Yeah.
recent ones. Sorry, I have to go back and pull the ones I put in. All right. So you yeah, I'll pull from mine, you pull from yours. All right. So we're gonna alternate for a few, and when we get tired, we'll just stop. But so I hear superheroes read Chuck Norris comics.
Chuck Norris has no stop loss because he never loses.
I hear when hiking, grizzlies look out for Chuck.
And when Chuck Norris was a trainee learning to trade, the markets adapted to him.
When Chuck Norris looks in the mirror, his reflection won't look him in the eye.
Listen, Chuck Norris doesn't predict the price of oil. Oil just does whatever the blank Chuck Norris tells it.
Chuck Norris doesn't breathe.
We got kids listening here, so I got
yeah. Chuck Norris doesn't breathe. He holds air hostage.
The lie was not that Chuck Norris owned Enron. He did, but he didn't lose money. He made a huge profit on his long investment in Enron. Nobody has the guts to question how.
I hear cats would like Chuck-like reflexes.
Well, when told of fear and greed and their roles in the market, Chuck had to ask what fear meant because he didn't know.
Chuck Norris can make a Happy Meal cry.
Chuck Norris receives a commission from Wall Street every time he trades.
I heard once a cobra bit Chuck Norris, and after 3 days of pain and suffering, the cobra died.
Yeah, listen, the world is not going through a food crisis because of speculation. Chuck Norris simply had a larger breakfast than usual.
I hear the sun sets every day because it doesn't want to be caught staring at Chuck Norris.
One time, Chuck Norris took a loss on a trade, so he roundhouse kicked it, and a loss has never shown up ever again.
Death once had a near Chuck Norris-like experience.
Chuck Norris was short 1 million of Bear Stearns shares 2 days before rumors hit the street. He recalls the position as one of his least successful trades.
Chuck Norris doesn't wear a watch. He tells you what time it is.
Listen, Chuck doesn't trade with trends. Trends follow Chuck's trades.
I hear the boogeyman checks under his bed for Chuck Norris.
Chuck doesn't speculate when he trades hundreds of contracts on hogs, wheat, corn, OJ, coffee, fertilizer. This is just how he goes grocery shopping.
All right, one more each, Doug, and we'll wrap it up. So, listeners, I hear Chuck Norris sleeps with a pillow under his gun.
Oh, man, there's so many to choose from now. Let me see what I'm going to end up here. Chuck Norris went on a shopping spree last weekend and charged $350 million on his MasterCard. Hence, MasterCard will report a charge off of $350 million in next quarter's earnings release because nobody dares ask Chuck Norris for payment.
Uh, Chuck Norris calendar goes from March 31st to April 2nd because nobody fools Chuck Norris. And the
Look
last
at
one,
some, yeah, go ahead.
last one here, and we'll end it up. Chuck Norris wasn't beaten by death; he let him win.
There you go.
So
That's a
honor,
good finish one.
honor to Chuck Norris, who growing up was a icon for every kid. He was the toughest dude around, and it was all real. It wasn't this theater movie kind of toughness. He was the toughest guy around, and he was the nicest guy from what I've heard. Never met him, but from everybody I've talked to who met him, they said he was the nicest guy and very generous. So kudos to a life well lived, and yeah, we'll get to it.
Kirk, do you know how Chuck Norris? I mean, a lot of people can joke Chuck Norris arguably wasn't the greatest actor. Kind of had his quirkiness, which also makes a lot of fun in kind of these jokes and who he was and his history and legacy. But do you know how Chuck Norris became an actor? Like how that actually worked out?
No, what happened?
So he was actually the go-to guy because he's very, very real. I mean, well, there's a lot of actors, out there that kind of touted their success in the martial arts arena. He was the real deal. I mean, he kicked everybody's butt. They actually became the go-to guy for Hollywood to send their actors for movies to teach them martial arts choreography that they, to be more realistic in the movies. And it got to the point that so many people were going and training from Hollywood that they eventually just said, well, why don't you just be the one in the movies and we'll use you? And, one of the great scenes out there was when he and Bruce Lee fought in Enter the Dragon. That was kind of his introduction to Hollywood. But I mean, it really was that Hollywood discovered him because he was the one training everybody in Hollywood how to do martial arts. So
Yeah, that's pretty cool. That's pretty cool. I'm sure that doesn't happen anymore because they like a pretty face on the screen, but yeah, that's pretty cool. I mean, it's funny back in the day with Hollywood. You people could get into films, and you could break in if you were a star in some other thing. I mean, what was it? One of Bruce Lee's movies wasn't Kareem Abdul-Jabbar in one of those?
I think he was. It might have been the same one. Yeah, he was yeah, absolutely was in one of those movies.
Yeah, and I think Jabbar was like a legit martial artist. I don't know, but I that's what I'd heard. He's a, he was into martial arts, so putting him in there was kind of cool.
He was in Game of Death, 1978.
Game of Gift, yeah, that was it. Yeah, so yeah, so that's pretty cool. I mean, you see that now occasionally. You don't see it as much, but definitely happens from time to time. Um, but let's get into markets here because I think there's a lot of things to talk about, and because the markets are closed today, it'd be kind of an interesting day to kind of like talk about the war and what's happened, and there's a bunch of stuff I've pulled up about. I don't say the war, but just kind of global economics, so to speak, that I think would be helpful. So let me add all these in here. Let me see if I can get all these in here, and I'll start to push them out. All right. So the first thing I want to talk about is, see if I can push these. Sorry, it's going to take a minute to upload. All right. So I want to push out a few charts here because I think there's a disconnect between what we think and what reality is. And many times with the markets, that can be one of investors' downfalls is that, they hear something on TV and they think naturally, well, this is just the way it is. Well, here's an example of perception versus reality. Here's perception of what we think we get our oils from, and then there's reality. We think we get most of our oil from Saudi Arabia, and we don't. We get most of it from Canada. And this is foreign oil, by the way, not U.S. oil. you know, and so if you look at the reality is tiny. You know, we get very small amount from Venezuela and Colombia. We get a very small amount from Saudi Arabia, and we get, you know, but just shy of 10% from Mexico, and most of it's from Canada. The perception is everything comes from Saudi and Canada, and we get some from Russia and Venezuela, and it's not necessarily true. So, you know, I share this because if you just if you just listen to the media, and we talk about this all the time, don't watch the news. The news is going to poison your brain. It's going to tell you something that's not necessarily accurate, or it's going to sound true, but it's not actually true. People believe this because they keep hearing, well, Saudi and the 70s and, you know, oil shock, and oh my God, Saudi, it's going to happen again with the Strait of Hormuz. Yeah, oil prices went up, but none of that has affected us because we're not getting our oil from there. We are, but not enough. You know, we're getting oil from Canada or domestically. And domestically, we should have low oil. Of course, we don't because it's a global oil price. But it's important to understand that the perception is a really important part of this. Now, I also want to share this map real briefly. I'm not going to get into it, but I want to share this. This is kind of a global map of where oil goes and comes from. This talks about the origin. So the colored lines are the origin, and then the destination is kind of where it goes. So the yellow is India, the red is the Persian Gulf, China, which China doesn't have too much, but and then Malaysia, Singapore, South Korea. So this is these are all of the different destinations and origins. And so, you know, if you really kind of run through all of this, most of the oil from the Strait of Hormuz is supplying Europe or, you know, China, you know, or let's call it Asia, just because there's a bunch of countries there that all kind of fall into that. And those are the most impacted. So, you know, I know Trump gave a speech 2 days ago, and it was lackluster to say the least. It wasn't very clean in terms of answering any questions that anybody had, and the market sold off the next day in accordance with that, as it should have. He's saying it's going to last another 2 or 3 weeks. That to me just sounds like what he said 2 or 3 weeks ago, and then 2 or 3 weeks before that. So personally, I'm at the stage of not believing a word he says. I think initially, you know, what he said, I knew that there was a bit of positioning, and we talked about this on the show. You know, he was saying it'd be, you know, 2 to 4 weeks. He said it'd be 4 to 5 weeks, and it's 4 weeks right now, by the way. So we're not hugely in excess of that. But it's 4 weeks now, and he's saying it's another 2 weeks. Okay, it's still kind of within the realm of what he originally said, but along the way, he's done. I'll give him an A+ for this. He's done a great job at keeping the markets from crashing, because based on what's happened, the market should have gone down sharply. And what he's done is he's allowed the markets to pull the air out of the sails gradually, so the markets have declined slowly, which is good. I think the markets are way overpriced anyway, so the fact that this is happening is actually healthy. No one likes to lose money, but it's healthy that this is happening because things were just kind of crazy. And so what's originally, when the war happened, we talked about how the theme we were pushing prior to the war, and even at the start we weren't convinced, was lower interest rates and lower inflation. And, you know, so it'd be lower mortgage rates, lower gas prices, and we expected that that would happen. Now we had low gas prices. I think they were like $60 a barrel, somewhere in that range. Mortgages were 6%, but I expected to probably be dropping by election time, because the thesis is Trump wants to get, you know, maintain power, and the way to do that is low inflation, low prices, make everybody feel better. Main Street feels better. That's not happening at the moment. What's happening in the moment is the opposite. Interest rates are climbing. The inflation probably will be higher. We won't know until the data's out, but we suspect inflation will be higher. Gas prices are certainly higher. You know, mortgage rates are not declining. They're up a little bit, but the yield curve is flattening. So nobody's really talking about this. There's a handful of people that are, but most people aren't talking about this. But the yield curve is flattening. Now, what does that mean? Well, a yield curve can flatten. Let me explain the yield curve really quickly. Okay. So the yield curve works like this. Um, Short-term treasuries, let's say like a 3-month treasury, might be paying 3.5. I don't know what it actually is. I have to pull it up. I can do that when Doug's talking, but let's say it's paying 3.5 for the 3-month treasury. And then there's like a 10-year treasury. Let's say it's paying, 3.75. And let's say the 30 years paying 4. Okay. That would be a positively sloped yield curve, right? The longer the maturity, the more yield you get. And that is normal. That is the way yield curves should operate, because the longer you're holding, the more risk you're taking. So you want to get paid more for that risk. Now, for the last 2.5 years, up until somewhat recently, we've had an inverted yield curve. And what that means is short-term rates, like 3 months rates, were like 4. And these are example numbers. These aren't actual because I have to pull them up. But the short term might be 4, but then the 10 years like 3.75, and the 30 years like 3.5. That would be an inverted yield curve. That's usually the sign of an impending recession, right? And so here's how that translates. When you have an inverted yield curve, it means the banks aren't making any money, and the banks aren't willing to lend, because what they do is they borrow on the short end and they lend at the long end. But if it's inverted, they're not making any money. So why would they loan money if they borrow at 4% and then they loan out at 3.5? They're losing money. Doesn't make any sense. So banks make a lot of money when you have a positive slope yield curve, and we had a pretty steep yield curve for the last 6 months or so. I think it was, but now it's starting to flatten. Now, a yield curve can flatten one of two ways: either the short end goes up, or the long end comes down. Now,
Hey, Kirk, I've got a chart I just added that you might want to show that kind of goes with what you said. From
Okay, yeah, I had a site I was going to pull up, but I'll look for that. Here we go. Okay, perfect. Thanks, Doug. All right, so here's the chart Doug was talking about. So it looks at basically last month and then this month, and last month was a lot lower. This month is higher, and it just shows the difference in this. It's hard to see, but if there's some ways you can track this, and if you're interested, just shoot me an email. I'll send you this. But there's some ways to track this. But basically, what you're seeing, and I'll pull the inverted one too from unless you want to pull it from like a few years ago, or I think it was like last year. But the point is, here's what you need to know: is that if the yield curve is going up, so if rates are going up, that means bonds are losing value. Okay, so if you own bonds, you're losing money by owning bonds right now. Okay, the safest way to own bonds is on the short end, so like 3 months, because it doesn't change that much. 30 years, you could lose a lot of money, and I'll pull some of the numbers. Point being is, when interest rates are going up, you don't want to own bonds. When they're going down, you want to own bonds. You make money when interest rates are going down, not up. So our thesis prior to the war was rates are going down, which they were. And now that the war's happening, it's almost the opposite. Now, here's an investing lesson for you. Most people have a thesis that interest rates are dropping, and I still think that's going to happen. However, I recognize that there's some new information out there. The new information is there's a war going on. And the war means that all my data is now different. So if I originally thought, as we talked about in the show, that interest rates are going to decline before the election, that's my thesis. Trump wants to maintain power, which means lower rates. And he's a real estate guy, so lower rates. So my thesis is lower rates, which means bonds should do well. And my thesis is also lower oil. Now, what's happened? Well, beginning of March, we went to war, oil prices went through the roof, and interest rates have gone up. So my thesis is wrong. Is my thesis wrong? Not necessarily, but tactically, my portfolio is positioned wrong, because before, my portfolio would have been long dated bonds, because rates come down, long dated bonds do well. And I don't short oil, but I wasn't really into energy. I would not have energy, basically, if oil prices are going down. So if you're looking at a portfolio, you would say, all right, we're shorting oil and we're long bonds, as an example. I'm not telling you to do this, not advice. I'm just saying this would be how you would do this. Okay. So you'd be short energy and you'd be long bonds, right? Long bonds. So you'd be holding long bonds. And so that's what you do. But what happened? The war did the exact opposite. Energy did really well, and then bonds didn't do well. Well, what most investors will do is say, well, I'm still right. This is going to be over soon. I'm still right. And I'm going to be correct. And that's your ego talking. Um, and what that means is basically, okay, information has changed. If I were to invest today, would I do the same? Hell no. Absolutely, I wouldn't. I'd be doing the opposite, right? Be long energy and short bonds because that's what's going on. And that's how you should play the current events. The problem is most investors get stuck in a prior set of information and they might eventually be correct. But from now until then, you could lose a heck of a lot of money. And you might also be wrong in your thesis. Because while my thought was Trump wanted this to happen, and I still think he wants it to happen, he could want something else to happen even more, which could be what's going on now, is the Iran thing. Now, I think the Iran thing will probably turn into a bigger problem for him than he realized, but I'm being hands off with speculation on the war because I don't trust any of the information. People used to say, you believe none of what you hear and half of what you see, but because of deep fakes, I believe none of what I see and half of what I hear. So, you can't believe anything with this war. And so I believe what the market believes. So if the market is doing something, it's showing what it believes is going on in reality. All I care about is the price. If oil prices go up, that means people think that we're going to be there longer. If they go down, it means we'll be there less long. So the market is the best truth teller because you've got millions of people out there buying and selling based on information, and the biggest ones tend to be the most correct. So the price tends to go in the direction of the big institutions who tend to have a lot more resources than any of us. So that's how I would dissect this. Is I look at price and say, what is the price telling me? The price is telling me that that they didn't like Trump's speech and that we'll be there longer. And oil prices went up a lot higher, and the markets went down. Now they did revert, but Trump and his team are doing a great job at managing expectations of the war. This is why I said he gets an A+ in that category. You may not like going to war. I don't think that we should be there. We're not talking policy. We're talking just the fact that what he's doing to manage this, like from a persuasion and influence perspective, A+. He's managing the market so they're not crashing. Now, I don't like that because I like making money when the market crashes, but that's just a personal thing. So, but for everyone else, what you want to think about is how are you positioned for the war? Are you really set in your ways, or have you changed your mind? Or is it possible that this is something you cannot discern at all? And I would argue that nobody can tell what's going on in this war except for Trump, and even he'd know the best, but he's not telling anybody. So I don't think anybody can really tell what's going to happen. I have my suspicions and I have my thesis short term, but I could be wrong, and I'm watching the price. I know that the war could end at any date, and the markets probably will rally and everybody will feel better. Oil's going to drop, interest rates, everything's going to go the way that I originally thought prior to March. But until then, I'm going to be wrong. And if we're here for another month, then I would drastically change my original thesis, is that Trump wants to retain power in the midterms, because I don't think he'll do that if we're here for another month. It will affect the economics. It will not go in his direction. Yes, I do think we'll have lower oil prices by then, but I do think inflation is going to pick up and interest rates might pick up. So I think it's going to be a bit of a quagmire if we're here for another month. But like I said, he's the master of mastering sentiment. So I'm hands off. I'm just looking at price, and I'm not getting emotionally tied to a position because it's not something I can control. I can't control the price. I can't control the war in Iran. I can't control any of it. All I can do is control how I feel about the prices and am I willing to make investments accordingly. That's all I can control is my own behavior. I cannot control anything outside of myself. And I'm saying this to just bring into perspective the fact that we as investors feel like we have control and we don't. You have no control over anything outside of your own actions. Your actions is all you can control. So, that being said, we emotionally believe certain things that Iran's good, Iran's bad, this, that, the other thing. That's what we believe. But that doesn't impact truth. All it impacts is your behavior. So if you're trying to get better behavior, what you should look at is the price and say, what is the price saying? And does this make sense to invest in this market? Or does it make sense to just sit in the sidelines and just wait? So if the market jumps 10%, if Trump's announced the war's over, who cares? Who cares? I mean, you're not trying to pinch every penny out there. You're trying to get the direction correct, and you're trying to make sure you don't lose big. Because we could very easily go down 20 or 30% from here, and it wouldn't even be a stretch. Wouldn't. If something really bad happens, we could be down 20 or 30%. I know that. It's sometimes easier to sit in the sidelines, believe me. You don't want to lose 20 or 30% in your portfolio. You want to be in cash so you can buy at that point, but you don't want to be in that position. So it's okay to sit in the sidelines. Markets are not that far off all-time highs. You're not missing out on that much.
Is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right, I said it, free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here, see? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today.
Anyway, what are your thoughts, Doug?
You mentioned something. I've got a couple of charts that I threw in there, and you mentioned something that I thought was really interesting. Is just about how you feel the markets are overinflated. And actually, I saw something today which certainly needs to be heeded. Tesla just announced that they've got 50,000 vehicles sitting on lots that they can't sell. Now, I don't know if people are aware of this, but Tesla's price to earnings has been balancing somewhere in the range of like 325 to 375. Now, normally when we take a look at, say, like the S&P 500, we're talking a price to earnings area of around 20, to 25. Some companies, a lot of your IT companies, when they call them stretch, when they get into like the 70s and 90s. So 340 PE is really, really dangerously overpriced. So when you're taking a look at 50,000 cars that aren't moving, and a lot of that price to earning is about this wonderful speculation that, Tesla's going to pay you for the risk of holding it, it's something to be noted. Now, I say this in counter to a new chart that just came out this week that's talking about the S&P 500's forward PD. Now, I would be very cautious of Tesla at this point in time, because if they are already a high price to earnings and they got 50,000 cars sitting on lots they can't move, I would say that if I were a betting person, that would probably be considered to be a very risky bet when you can't sell cars and you're relating the current price to the earnings. Something's going to give. 50,000 cars can't move. Earnings might drop Can't predict that, don't know, but it certainly seems like if you can't sell your product, that's going to hurt earnings. And ultimately, then the price would have to come down in line to that. So I would certainly look at Tesla as a risk. But general price to earnings forward P&E, now that we've had this movement in the markets, which is certainly correlated to Iran, it's definitely escalated with the markets recently, but actually as a trend that started middle of last year. And interestingly enough, forward P&E is something that we've kind of peaked out around 23 to 24, probably around 23 as a high. If we go back to say right after 2021, and this chart doesn't go back that far, so we could call some of this a chart crime because it can't look further. But if we were to look just at the 2021 era, it kind of peaked out at 2023, started to decline, and then actually fell well below a 24 forward price to earning on it, when it went into 22, 23. No surprise, the markets pulled back sharply with the rise of interest rates. And then it started to climb back up until we got into late 2024, hit that 2023 cycle again, and then once again fell into 2025 back under 20, and then started to climb. And middle of 2025, it hit that 23 again and has since fallen back. So from an aspect of value of overvaluation, and I'm not saying that, I disagree with you, Kirk, that we're not still overvalued. And I'm also not telling people go buy the dips in the markets right now with what's going on, because we have a current conflict. They just took out one of our jets, an F-15. Iran just shot down the other day. I think I heard that we were able to rescue our pilots because they were able to have hostages.
I thought we got rid of the air defense, Doug.
Mostly, I mean, 2 jets in a month is not, it's pretty good, but you're
They
right.
got all of them. Didn't they get?
Yeah.
Didn't we get all of their Navy and all their air defense? How did
we
they
were
kill
told
those
they're
things?
all gone. I guess that didn't turn out to be true. So that's
interesting.
Exactly what that plays into. So, as long as we're in this conflict, we can't really make any significant bets, and that caution should remain. But it should be said that whether or not it's directly, aside from the war, we do see this trend where, at least going back over the last 5 years, where the forward P&E has struggled to get above about a 23, and that is the average about 20. We are now back after a compressed 11% slide in the P&E since the start of the year. So it is definitely accelerated. We are back below that price to earning on the 5-year average. Now, like I said, this could be a chart crime. I don't have what that price to earning average was going prior to 2021. So if this chart was to show that the average over 10, 15, 20 years was actually a 15, we are still elevated. But at least we have definitely seen a pullback there. So you could argue it is less overinflated, if not better. The other thing that I wanted to, if we just want to stay, Kirk, since you're running the charts, the other thing too is that how are we looking at the performance of first quarter? We've talked about things like January effect, and we've talked about I've talked about how coming off 2 years of double digit, performance in the market has generally been bullish. Well, just to kind of continue that trend of conversation, looking at Q1 performance and what that tends to mean from a outlook for the rest of the year, dating back to 1980. So in this case, we have 46 years of data. So we're not a chart crime in that relation. The S&P has proceeded to gain 7% on average during the remainder of the year following a negative Q1 return. And ultimately, it has generally performed about 8% on average during a positive Q1 return. So what is this saying? It's saying it doesn't really matter whether we've been positive or negative coming out of first quarter. The next 3-quarter return has generally stayed about the same, between 7 and 8%. So it really means that what we're looking at has just happened ending March 31st. We can't use that we can't use that as any kind of indicator as how the rest of the year is going to go. The only thing that we can use as a potential indicator is looking at the challenges we're facing right now. And again, the one caveat is that we are currently at war. But on a positive note, going into the first quarter of 2026 on S&P 500 year over year earnings per share growth, we just hit our sixth quarter of double-digit EPS growth. It's expected to deliver. It's expected to deliver the sixth consecutive quarter, which would be the longest streak since 2011. In Q4 2024, it was up 18%. And then it, subsequently in the following quarters, it was 13, 12, 14, 13, and then 12. So now ultimately, again, what drives the stock market? Well, it certainly can be argued with confidence that there is a causative effect of market performance in terms of profits, earnings per share. So as long as companies continue to pump out profits, it's probably going to be highly correlated to a successful run in the markets continuing. Now, that being said, profits are starting to be under pressure. And if we look at asset class performance and distribution by asset class and style as of March 26, so these are very, very recent charts, we can see that I know that you're going to love this, Kirk, because I know where you love to play is value. It's been your bread and butter, and we've talked about this for years, that value has really struggled. Well, U.S. equities in the Russell indices as of March 21st, we're finally, if you look at this, and I don't know if you're showing the chart, Kirk, but from reds to greens, we are actually seeing that value has finally started to show us some strength. That if we look at year-to-date returns as of March 26th, value is positive across the board. Value large cap 1.5%, mid cap's up 3%, small cap was up 4.7%. If we get into blend, which of course holds a large chunk of value along with growth, blend has been up in the mid cap and small cap sectors as well, 0.7% mid cap, 0.7% small. Growth has been the dog, and we've talked about that. It is, we're down 10.6% on large cap growth. That led actually to a negative 4.9% in blend, and large cap and mid cap and small cap growth both negative as well, but they were strengthened by a better outperformance on value. Now, if we take a look at weekly returns, small cap value is the one that's still been holding up pretty strong. And if you talk, and I'm not going to get into who makes these recommendations, but small cap value has historically been one of the better performing asset classes, better than typically small cap growth, which is more volatile. And it's starting to show back to where it has historically been, that it is a place that has a little less volatility. If we get into international equities, developed market, large, mid, and small. Developed market is doing better. Emerging markets, again, weekly returns, not so much. But actually, year to date, emerging markets has been the real winner. It's large cap emerging markets up 5%, mid cap 6.3%, and small cap 4.9%. Now, I'm going to talk about something there, because emerging markets has some real pressures on it right now, which I'm going to talk about, and has a lot to do with what's going on with the conflict. Now, on the bond side of things, if we take a look, where have things been successful, Kirk? Weekly, short-term treasury, short-term duration, up, mostly flat, 0.1, and actually year-to-date, 0.8. All other areas of fixed income are negative for the year, but long duration has felt the majority of that pain. So again, looking at where to be, short-term duration, and recently, we haven't lowered it. They did not lower interest rates again at the last Fed. We also did see a spike recently, although it has nothing directly to do with the Fed. But mortgage rates spiked up again, over 7%. That could create some pressures. Now, I want to round this off by talking about some real areas that I think you put some notes in, Kirk, that I think are important to note coming into today. We are starting to see that the global oil supply choke points, and I did put a map there on those choke points, are starting to have some effect. I was looking at the map this week. You can realize, and you realize real fast that this isn't just about Iran. It's about how fragile the entire global energy system actually is. There's been a lot of talk over the past couple decades about globalization. There's a lot of it is political speak. What this is showing, there's an economic speak. Globalization works really, really well until it doesn't. Okay. Now you can argue what's causing that disruption, and you could target that politically, but the fact is, it just shows how fragile it can be. The Strait of Hormuz, the Suez Canal, the Red Sea routes, all of which major choke points that can have a very, very quick, geopolitical, impact, can cause all of that to shut down. Now, when we take a look further, what countries are most dependent on energy imports? I have a chart for that as well, which kind of explains that it isn't hitting everyone equally. Countries that are dependent on imported energy are getting squeezed first, and they're getting hit hardest. So those energy shocks, they're not going to spread evenly. They're going to concentrate that pain, and that explains exactly why certain countries are going to get hit more than others. We are starting to see that. Now, another chart that I have about global inflation forecast by country. This is also goes back to predictions. And I love what you say, Kirk. It's like, hey, I don't know. It depends on what's happened. I may say something completely different 3 months from now. The global inflation forecast chart for 2026 is already becoming outdated. Everyone expected inflation to keep falling this year. Oil just changed that assumption in a matter of days. So just keep in mind that forecasts, when you hear them, they're always assuming stability. Markets are going to tell you where the price disruption. Going a little bit further on that, if we talk about, if we look at these global trade routes, you're going to realize that those disruptions in one region don't stay there. They ripple in other places. And ultimately, the global system is already leveraged. Those shocks hit harder when debt is high. Now, I don't know if you want to cover this, Kirk, or maybe I know you put some things about how other countries, are getting affected. Things, especially in Asia, are getting hit really, really hard right now. Do you want to talk about that, or do you want me to continue?
Do it quickly, because I'm gonna pivot to a similar different topic.
Okay, then I'm gonna make it real quick. So, places like Philippines just announced that they're going to a 4-day work week. Sri Lanka has talked about fuel rationing. Pakistan's got fuel cuts and school closures. Bangladesh rolling blackouts. South Korea strategic reserves are being diminished. Japan, they just issued the largest oil release ever. Thailand is now doing work from home mandates. Egypt's shutting businesses early. Slovenia's got fuel caps. Vietnam, fuel transition. Laos, forced remote work. Different countries, different economies, same response. So this isn't necessarily about markets reacting to war. It's about economies adjusting to energy scarcity. And overall, if you look at the charts that I showed there, we are highly immune to the immediate impact of oil. Asia is highly dependent on energy access, energy prices. You're going to see, and we're already starting to see it in the weekly reports. Emerging markets react first. The developed markets are doing better right now, but they will react later the longer this goes. So those markets often ignore early signals. This is an area where the world is showing you the problem before the markets price it, and might be opportunity to position yourself to be prepared.
Yeah, no, it's an important point that we wanted to discuss today, is that, countries internationally are struggling with this. Depending on the country, depending on the amount of reserves they have, China's fine. China's got I think somebody said they've got a year's worth of reserves, so they're fine.
Mhm.
But a lot of countries don't, and so a lot of countries are going to be struggling here. So we talked about before, the longer this war goes on, the worse it's going to be for everybody. And by
It's
everybody, I
dominoes.
mean everybody but the US. We have a huge amount of oil domestically. We've got Canada. Now we've got Venezuela, which is pretty much tar, so that doesn't matter much. But for most of the stuff we need, we're fine. So us throwing stones at a glass house is fine, because we got plenty of reserves. We're not going to run out. People, if anything, what Trump is doing is making money for the oil companies domestically, because he's just basically shutting off oil going through the Strait of Hormuz for everybody except for us. Oh, hey, I think he made this comment. He's like, well, we've got plenty of oil. If you want some, you can have some. We've got plenty. I was like, oh my God, please tell me that's not the reason we're attacking Iran. Like, I mean, I get it. It's pro-America, America first, but still, like that's going to war over that's over the line.
Hey,
But
Kirk, if you just want to share really quickly, I just put in a chart that shows how much oil that each G7 country holds in reserves. And China's got 260 million.
Yeah, China's got a lot.
I believe this is barrels, but we sit, yeah, it's barrels. 260 million puts them number 2, but we're sitting number 1 with 415.4 million barrels. After China drops to France at 170 million, Germany's got 110, Spain 76 million, Great Britain 38 million, everybody else less. That makes them highly susceptible to a domino effect here.
Yeah, I mean, if you look at things like, I think we consume about 21 million barrels of petroleum a day in the US. So even that doesn't last that long, right? So, that's reserves. But at the end of the day, I actually have to question this, whether this is reserves or how much we're producing, because we do have oil reserves. We've had that for a while. And, it doesn't really amount to much. But, what's that, like 20 days? 20 days reserve. It's not much, but we're producing oil. And that's the question of, are we producing a lot more than we're using, and are we going to run out? Well, the answer is no, we're not going to run out.
And 2 points on that. The asterisk for Spain, it shows that that's required by law, but at the bottom it also said, and I think it's important to note, Canada does not have any reserves.
Right.
That's what it says on the bottom.
So this is reserves, not what's being produced.
Yep.
So, all right. So I want to kind of slightly pivot into a related area that is really important to that we want to discuss. And here's the market so far this year. This is the stock market. At the bottom, we have different sectors: basic materials, communication, consumer cyclical, defensive, energy, financial, healthcare, industrials, real estate, technology, and utilities. So what this chart is showing is the index drawdown. So how much the index is drawn down. So like the financial, so let's say like the XLF is the financial, it's an ETF that's indexing the financial companies, right? XLK is technology, XLU is utilities, and so on and so forth. And that's one company's version. There are many versions I'm not preferencing, but so if you look at one of those, the dark one, the sector index, that would be how much is lost. So they're really not down all that much, right? The basic materials are down around 8, cyclical is down around 11, financials around 12.5, technology is only around 10, and energy's down 0.5%, which is weird because I thought it was up. But so that's the sectors. But then the red is the average stock drawdown. So this is the average stock in the index. Now these indexes are filled with big companies, right? So if you're looking at, I'm trying to think of which one, which is in which. But if you look at like consumer staples, Walmart's the biggest one, right? And then there's Costco and there's a few others, right? So each one, they've got stocks, and technology, I think you've got some really, really big companies. Now, that being said, if you look at the average stock, how much down is the average stock? Well, technology, the average stock's down around 25%, even though the index is only down 10. Well, I don't understand what's going on there. Well, here's why numbers and statistics will lie to you, because you might see, oh, here's the average stock drawdown. Oh my God, it's 25%, but the index is only down 10. Well, here's the thing. For the S&P 500, I think like 30 to 40% of it is made up of like 7 to 10 stocks. I don't have it in front of me, but there's somewhere in there. Basically, I think 10 stocks is like 40% of the index. Now, the rest of the 490 stocks make up 60% of it. So there's a lot less impact on the index's return from everybody else. Those 10 impact everything. So if those 10 are doing well, the index is fine. But if the 490 stocks are doing crappy, like for example, looking at technology, which is a big divergence, well, then you could have the biggest stocks doing the best. it's actually not the case with technology because the big stocks are not doing great. Like Microsoft's down like 25%, and a lot of them are down a lot. But my point is, you have to understand that this is not, when you hear numbers, a lot of it is a chart crime or fake news that is being used as a narrative to bait you. This is just looking at the difference, and it was a shocking difference, which is why I'm sharing it. But internally, within the index, a lot of companies are not doing well. But you're not going to see that in the surface through the S&P 500 and the Dow and the Nasdaq. Those aren't down that much. They're down, like, if you look at these, they're down right around 10% or a little bit less. But a lot of the stocks are down a lot. So just keep in mind that just because you see the index, oh, it's not doing too bad. If you own the index, but if you own a lot of stocks, you might be in for more of a hiccup. Now, I also want to share this. Now, this has been a trend. So people talk about, well, Trump's really screwing the pooch because people aren't going to like us. Yes, I agree. What he's doing is causing a lot of countries not to like us very much. And they're not going to do us very many favors. Now, we in the U.S. have had a lot of, sorry if you can hear my dogs. We have a lot of influence globally. And if you need someone to buy our treasuries because we're printing enough money, a lot of countries would do that. And we would negotiate with them and give them stuff. And in exchange, they would take our debt. That's been happening for decades. That's nothing new. But there's a trend starting like in the early 2020s where fewer and fewer holdings were held internationally. Many more are domestic. This is what happened with Japan, where Japan had international holdings, and now most of their debt is held internally by their own country. Well, that's okay as long as the country doesn't liquidate the debt. The central bank can buy it, but ultimately you're going to need other people to buy your treasuries if you're going to keep printing money, which is what we're doing. So this is not an immediate problem. If you see the scale, it's not urgent, but it's a trend. It's a trend you should be aware of. I also want to talk about my prior thesis, which is not a thesis today, but if the war stops soon, this is a thesis to keep in mind. Prior to the war, here's what was happening. Consumer staples were doing great. I think they were the best performing sector prior to the war. Utilities actually performed reasonably well. Healthcare was not. Real estate was kind of flat. But industrials and energy were doing well, right? And materials. So those were some of the best performers: staples, industrials, materials, and energy. Those are doing the best before. If you look at a cycle in the markets, certain things work in certain times, right? And this is a little complicated, so you can take some time to look at it later. But what's happening here is the economic cycle happens, right? At certain points in the cycle, you're going to invest in certain things. Invest in equities on the way up, commodities at the top, cash on the way down, bottoms at the bottom, bonds at the bottom, and then equities on the way up. So if you look at these different pieces, here's how you would invest in a cycle. Well, prior to the war, we were at the top of the cycle. What was doing well? Well, all of these areas, commodities are doing well, industrials, energy, financials were doing well. Like all those sectors were doing well, and they typically do well at the top of a cycle. Now, as things get worse, you want to be more defensive. Cash is always good, but you want to start thinking about, value like staples, utilities, healthcare. You want to start thinking about that as the recession kind of starts to pick up and things start to decline. It doesn't mean there's a crash like we've had at the war, like there's been a deleveraging because everything has gone down except for energy. However, you've also seen a yield curve which is flattening, which is starting to happen now. So there's some conflicting signs here. I don't know if this war will send us into a recession. I don't know if we were on the edge of a recession anyway. We don't know because you can't go back and look at different scenarios. But I can tell you that what you should be looking at is you should have a target portfolio that you're looking at and saying, all right, I'm not investing yet, but I want to think about it and I want to have the allocation set. So this is what we do. So we're looking at what's the next stage. The next stage after energy, financials, materials, industrials, after they were doing well, and this is removing the war, then you want to start thinking about staples, utilities, healthcare, bonds, but we're not there yet, right? I don't know if the war ends tomorrow and all of a sudden it goes back to the top where we were in the top. That could happen. But you should be thinking about these scenarios in your head of how you should be investing. Don't just think, well, I'm buying the dip in tech. No, we're past that. We're past buying the dip in tech. The bull market in tech is it at the moment it's over. I don't something could happen and bring it back, but at the moment it's not coming back the way it was. These other areas are starting to do well and starting to get interest. So rather than buying the dip in air quotes, you should be looking at other parts of the economy that are also getting money. Because if you're buying the dip in Bitcoin and it keeps going down, you're not doing yourself any favors. If you're buying the dip and tech keeps going down, you're not doing yourself any favors. Now, tech is getting taken out to the woodshed because of AI. I don't know if that's a real fear, but the market seems to think so. Now, maybe that fear is cleared up and all of a sudden technology starts to pick up again. I don't know. But at the moment, the market doesn't seem to like software very much. Software is just absolutely getting taken out of the woodshed. Well, I remember when I started in the industry, the smoking companies, the tobacco companies, were taken out to the woodshed. I forget the numbers, but it was like Philip Morris and Altria, all these companies were like down in single digits. They were just totally obliterated. There was a time in 10 years later where McDonald's was taken out to cleaners because the health industry, like everyone wants to get healthy, and so you're not eating McDonald's. This routinely happens. And then it's proven to be wrong, and then the market starts to take it up. That could happen. But what I'm saying is if you're trying to buy the dip and catch a falling knife and all the things people tell you not to do, don't do it. Because if those companies come back, you're going to know the stock's going to start to come back and continue to go higher. But if technology just goes back to where we were prior to the war, I'm not excited about that, because for 6 months, the market didn't move. Nothing was happening. That's not a good sign. But I think staples were up like 18% prior to the war. Really? Because the rest of the market wasn't doing anything. So just keep in mind, there are other sectors out there. Don't get caught into technology all the time, because that's the way it was for the last 15 years. It doesn't mean it's going to continue. It means that the cycle is happening. And because the cycle is happening, things change, which means you should change. It means your thesis should change. So our thesis is we've got these different buckets based on where we are in the cycle. And right now, we're trying to figure out, are we in the peak part of the cycle still, or are we into the recessionary part of the cycle? Now, the war may change that, and it's going to be unclear until it's over. I would say we skip the top and go right into the recession if this war continues. If it doesn't continue and stops, let's say like tomorrow, then we'll have to see how the market prices it. But I would be very aware of these cycles because they could change at any time. Staples are doing the best. Well, staples aren't typically in the top of the cycle. They're typically when it starts to roll over. So we were still at the top, but we started to have staples. So if you look at this, we got a few of these. We shared this one. This is kind of like the trend of how to look at things. Start with staples and utilities and healthcare and real estate. It starts with earnings uncertainty. Then there's liquidity, which we won't get into today. Interest rates, and then credit exposure. Those are all impacting now. Financials are getting credit exposure impact. Rate sensitivity also impacting financials. I wouldn't touch financials right now. I think they're dangerous. But here's an asset allocation thing we saw from a report. And what it's talking about, and I'll explain this just because it may not be clear. The columns at the top are the cycles. So the turbulence part is this part where it's risk off, where the market declines. That's turbulence. You see it right here, turbulence. Rebound is when it bottoms and starts to pick up. Okay, that's the rebound. Calm is when you have a market that's just kind of like it's starting to go up, right? It's in this trend. It's an easy trend. It just keeps going up like we've had for the last 15 years. And then the speculation is the top. That's what we were in before the war, and we still could be, but prior to the war, we were definitely in that speculation category. So the way to look at this is what does well in which stage. So in the turbulent stage, pretty much defensives, bond duration, that's it. And cash. They don't have cash here, but cash would be another one. right? Speculation, which would be the top things that did well, energy and commodities. Lo and behold, they did do well. Um, and if you look at the rebound stage, so at the bottom of the market and when it starts to take off, technology and cyclicals, right? Credit and equities, right? That does well. In the calm stage, you have pretty much risk on, which people talked about prior, risk on, risk off. This is risk on. Just, hey, put it in the market, let it run. You're good, right? Equities do well, commodities do pretty decent. You've got cyclicals, technology, financials, everything does well pretty much in the calm stage. Certain things don't do well, like defensives and bond duration. But in general, this is how you should think about the markets. Now, ultimately, this is a framework. This is not a color by numbers directions. Okay. Because anything could change. We could be in the hypothetically the rebounds, or let's say we're in the turbulent stage, and energy can do really well. Like I said, we could be in the fourth time where the market's declining, but energy is doing really well because of the war. The war throws everything up against the wall. You can't rely on anything when there's a war because it's not about information. It's about speculation of whether things are going to get worse or not. That has nothing to do with fundamentals. It has nothing to do with cycles. It's just because the war will pretty much throw everything out. Throw the baby out with the bathwater. Your best. My rule of thumb is go flat. Just get rid of everything and just sit in the sidelines until it's over. That's my rule. It's a rule I use. I'm not saying you should do that, but I'm just saying, like, it's better off because you don't know what's going to happen. When you have deleveraging, like, which is what we've seen, everything goes down. So we just sit in the sidelines. Why bother taking all that risk? So once the war is over, we'll know better as to which one of these are in, and you can take positions. But use this as a framework, right? So if you say, all right, based on the framework, if we're in the speculation phase, I should be invested in energy and commodities, defensives, and that's it. Okay. But if one of those is wrong, you don't sit around and say, well, I hope it comes back. Watch the markets, see what they're doing, and figure out, is this correct or not, right? It's your thesis, but if it's wrong, you change your thesis, right? Yes, energy was doing well before the war. It's doing well now. Is it going to do well if the war ends? I don't know, but I'm not going to stick around and find out. I think oil is going to go through the floor about shortly thereafter. So I wouldn't stick around. But it could go on for another 5 months, which means, do you want to miss out on that? I don't know. So these are all questions that you have to ask yourself when you're managing portfolios. You can't just take somebody's word for it and just keep investing in the same stuff you did 10 years ago because it worked then, so it's going to work now. That's not how markets work. They change. You need to change with them. So, Doug, you want to final thoughts and wrap it up? Actually, one more thing. I just wanted to share these two frameworks just because it's important to note, and then I'll let Doug wrap it up here. So, if you look at this chart, there's actually two charts here. So one, this is also a framework you should keep in mind for the markets based on the war. So this is just an illustration. It is not accurate. It is meant just to illustrate points. This is a very common market cycle. Okay, markets go up. There's confidence. People buy the dip. It goes up. It's people are way over enthusiastic, and then it goes down, and then it crashes, and then people try to buy the dip, and it crashes again. Then people panic, and then it goes up, and then it goes even worse, and then everyone's just they just don't want to open their statements, and then it starts to what they call climb the wall of worry, which is yes, there's bad news, but the market goes up anyway. That's the wall of worry. That happens at the bottom of markets when they start to turn. It's all bad news and markets keep going higher, and that's called the wall of worry. That's a good thing, right? The higher price is a good thing, right? And then there's anxiety, and then it crashes again, and then there's denial that it's going to go up, and then it just keeps going up. That's how you should think about market. I'm not saying it's exact, and it's not done to scale. It's just to prove that this is how markets operate, and you need to be aware. This is why risk management is so important, is that you need to be able to manage risk. If you're not managing risk, then you're pretty much taking the chance that your portfolio is going to go down 30 to 50%. That's what you're doing. If you're just buy and forget, your portfolio could go down 30 or 50%. It could. We haven't had a big recession in a long time. It could happen, and it will at some point. I should say it will at some point. Might be tomorrow, might be 10 years from now, but it's going to happen. And if you're not protecting yourself from that, then you're taking the chances that you could lose a lot of money. And if that's okay with you, then just buy and hold. But if you're not okay with that, then you need to have a strategy to protect your risk. And I'll get over this next time. I'm not going to talk about this time. But this is, we talk about liquidity. We'll talk about liquidity next time. But these are kind of like liquidity bubbles, and this is where bubbles happen, and this is where crisis happens. So it's just something to keep in mind. We'll get back to this next time, though. So, Doug, final thoughts from you, and we'll wrap it up.
Yeah. So one thing, I'll kind of segue and tie a couple things together. First of all, it was announced this morning. And again, I'll go back to what we said earlier. Can't believe anything. And as we talked about over the last couple of years, what I'm about to talk about has been revised over and over and over and over and over. So that being said, the U.S. employers, it was reported that U.S. employers added 178,000 jobs in March, and the unemployment rate ticked down to 4.3%, which is they're declaring a robust showing after a run of weakness. And we have definitely been seeing the monthly change in jobs had been systematically declining from around, the average was around 280,000, and it slowly declined down to where it was negative and has now popped back up temporarily. Now, this is seasonally adjusted. The average is calculated of a 3-month moving average from the Bureau of Labor Statistics, again, coming from the administration. This is something that I would get ready and prepared to see some adjustments. Also, keep in mind that it is, of course, Good Friday. So the nice thing about this, they didn't announce it today and any different than their normal schedule, but by announcing it today, we're not going to see any reaction in the markets until Monday. They are closed, but reality isn't closed. Just to segue a little bit, and I've got some charts that I just showed in there. I'm gonna segue this jobs report to something many of you have heard me talk about before, which is obviously the college, the impact of college. And one of the things that I think is really important to note is where are we seeing some of the biggest impact of graduates, and what does that mean in terms of jobs report? Now, if you look at that jobs report that came out today, you'd think things were all rosy. If you actually been following the news the last couple of days, or actually the last couple of weeks and months, you look at the layoffs that have happened at places like, a lot of IT companies like Oracle announced the other day, tens of thousands of layoffs. There's a number of different tech companies. So we're seeing a massive amount of layoff in that sector. That of course adds credibility to the fact that technology is challenged right now. So one of the things I wanted to talk about is, since I do talk about the college planning quite a bit, where are the most unemployed college graduates happening right now based on the U.S. Census Bureau and American Community Survey data? Well, number one, honestly, shouldn't have surprised anybody. It is anthropology. The unemployment rate is about 45,000 unemployed in anthropology. That's about 8% rate in that area. Again, I don't think it should surprise anybody. It's a very soft category, and obviously, it's one of those where, what do you do with it once you graduate? But what should surprise people, or at least those that haven't been paying attention, is number two right behind that is computer engineering. 90,000 graduates, college grads, are unemployed.
That's the wage, Doug.
This is the unemployment rate.
I know, but it says average wage.
Oh, thank you. 90,000 is the average wage. Thank you for catching that. What happens when you bounce around with charts? Yes. 90,000, hence the dollar sign, Kirk. Yeah. So 90,000 the average wage. But again, just under 8% of college grads are unemployed in computer engineering. But what's interesting is you go two below that and you see computer science at around, just over 7%. So really, they're calling computer engineering separate from computer science. But again, that's roughly a 14% unemployment, when you look at the combination of both computer engineering and computer science. So that's, that it's definitely concerning, and it tells you that there's changes, because we can go down about 10 more slots to information systems and management. That's also computers. And that's another, that is another one that's hovering over 6%. So I would say right now that is an extremely concerning number for people that are looking at that career. Now, where are we seeing the least? That is areas of science and engineering. Again, STEM should not surprise anybody that is having some of the lowest unemployment graduation rates for people coming out on that. Also, where are we seeing the fastest declining jobs in the next decade? A couple of areas that, in this report that we're seeing is that you're going to see most of it is a lot of stuff that AI can take care of. Absolute decline in jobs, cashier, number one. We've already seen it. The number of kiosks that have been built up. Office assistants, customer service reps, call into any company you work with. You're probably seeing a lot more automation. Fast food cook, another one. Bank teller, another one, that's high up on that. But a lot of these are going to be the areas that are disrupted. What I thought was interesting on there was corrections officer, Kirk. I'm not sure AI is helping that, but maybe more surveillance. But it certainly has been a pressure.
You'll be safe.
A lot of geopolitical pressures there in terms of law enforcement that I found interesting. IT support, though, is on that list. They're looking at about 27,000 overall decline jobs. Now, percentage-wise, clerical typist, number one, you can do a lot of work with AI and typing and stuff like that. But looking for things that are more, going to be a little bit more hands-on. We are seeing that they're saying, technical trade schools, but yet some of those things like forge operators, mechanical assemblers, medical fabricators, again, there are going to be areas within that what I think you're going to see a tremendous, they're predicting a tremendous increase in job reduction there as things continue to get more automated. But I'm also tying this lastly into student debt in America. Why is this important? Because if we're going to see 8 to 50, again, if we combine these, maybe even 15 to 20% unemployment coming out of college, it's going to be even more important that you're very smart about what you're spending. The lowest student debt in America is currently right next to me. It's over there in North Dakota, $29,000 in average student debt. The highest, should be shocked to nobody that this would be on the list, is DC. The schools out in that area are extremely expensive. They charge a lot. They don't give a lot of discounts. You're seeing $54.6 thousand as an average student debt based on the federal student loan debt borrowed by state. Where you're at, Kirk, it's right around in the mid 30s. Same here in Minnesota. So again, I think, we look at $1.83 trillion in total federal education debt with an average overall of 39.5 thousand. When we go to the one big beautiful bill and we look at the reduction of loans available now to families, you're looking for parents. The most you're going to be able to get is 65,000 from the federal government over 4 years. It's 20,000 per year maximum, but obviously 20,000 times 4 would be 80. So they're capping what you get per year and what you get total. That means more people going to private loans, which are going to be tied to credit score and availability. The federal government is trying to turn off that open checkbook and drive down the cost of schools, which have effectively soared because they knew that the federal government would basically lend anything. But that is going to create some definite pain points, especially as tuition and room and board remain high, available and access. When you talk about liquidity, I love that segue. That's gotten, starting 2026 to 27 has been forced down by the federal government to be extremely low. So therefore, planning is probably more critical than ever as these two things work their way very painfully back into equilibrium. So more than ever, it's going to be really critical for you if money and cost or matter. It's going to be more critical for you to do that due diligence to find out what you can afford before you get into a surprise where it used to be you just borrowed more than you thought you'd need to. Now you actually may be told you can't get the money. And that's a very difficult conversation to have with kids. So as we close today, step back for a second with these markets being closed. The world is showing you something important. There are 11 countries that I talked about earlier, different economies, different governments that are making the same decision at the same time to cut energy, conserve resources, adjust behavior. It's not coincidence. You need to view this as a signal. Here's where most people get caught. They're going to wait for that market to confirm what's already happening. They're going to wait for headlines to feel obvious, and they're going to wait till everybody else agrees. But by then, we saw this with silver and gold late last year, earlier this year, it's already priced in. The families who navigate environments like this successfully, they don't wait for the confirmation. They're listening to us. They're preparing before it's comfortable. And then once the risk becomes obvious, whether it's where you invest or whether it's planning to, what you're going to, how to retire, how to send your kids to school, it's already too late to prevent, to position for that. So at Mergent Advisors, my firm, we work with the families who understand that they don't want to guess. They don't want to chase headlines. They want to build structure. We map everything: income, assets, liabilities, taxes, college planning, retirement income, so that you can actually see how your plan holds up when conditions change. When you can see it clearly, that's when something shifts. You stop reacting. You start making decisions with intention. And most people, they're not going to do that. It's not because they can, it's because they won't take the time until they're forced to. So the real question isn't what the markets are going to do this week or next week. It's whether you're positioned before everyone else realizes they should have been. And if you want to see where that actually stands, not where you think you stand, then go to mergentadvisors.net, start the conversation, because by the time it feels obvious, it may be already too late to act early. And that's when those that plan, those that think ahead, those that are smart money are going to be ahead of the curve and take advantage of it. So that's another thing. And by the way, just a little bit of a plug for anybody that's a CPA, especially in Minnesota. I am going to be doing at least one, if not a couple of college funding related presentations for CPE credit for CPAs in Minnesota. We're going to be talking to a couple other states around that. So if you're a CPA and want to get some CPE, check the Minnesota CPA Society for more information. That's going to be coming out over the next couple of weeks or months.
Nice. Well, thanks, Doug. We're going to wrap it up here, give everybody their time back so they can enjoy their Good Friday and their Easter weekend.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.